Hi, this is Frederick Scott Smith. What is a debt ceiling? A debt ceiling is a legal limitation on the amount of national borrowing that a government can accumulate. It is a means to restrain government spending so a country does not have to borrow as much. Under Article 1 of the Constitution, Congress has the power to borrow, so they set a debt limit for themselves. Almost every year, the United States government has a deficit. A national deficit occurs when a government spending surpasses its revenue in a fiscal year. As a result, the government spends more than it receives in taxes or other means. Therefore, it has to borrow for most years, accumulating national debt. The national debt refers to the total amount of money a country owes to its creditors, including individuals, institutions, and other countries. It is the result of government borrowing to finance expenses and investments. Americans, the government, and the Federal Reserve own most of the debt. So, if you own savings bonds, you hold part of the debt. But contrary to popular belief, less than 30% of the debt is foreign-owned. When the national debt approaches the debt ceiling, the government cannot borrow more or spend as much. Originally, Congress authorized debt directly, but the Second Liberty Bond Act gave flexible power to the American Treasury. In 1939, Congress set a debt limit of $45 billion, but has raised it numerous times. If Congress does not raise the debt ceiling, it must slash a hefty amount from the budget. In 2023, $1.5 trillion in cuts may occur. The government may decide to delay or reduce Social Security and Medicare payments, impacting millions of Americans who depend on these programs. Cuts to programming may decrease the standard of living for millions of Americans. The U.S. military and national security could face reductions. The American credit rating may face a downgrade, making it more expensive to borrow. Less confidence in the American system may cause a tumble in the stock market. The dollar value could decline, and interest rates could increase. If too many of these outcomes occur or are too severe, it may trigger a global economic downturn and cause the United States to decline as a geopolitical superpower. In 1979, a deal to raise the debt limit came close to the borrowing capacity of the Treasury. However, due to procrastination and high investor traffic, a delay occurred in about $122 million of debt payments. Despite being considered a technical and minor issue, the event increased interest rates and payments. As the Great Recession and pandemic caused government deficits to rise above $1 trillion a year, the debt ceiling continually needs pushing up, and spending continues to increase. Some argue that confidence in the United States will continue if Congress does not raise the debt ceiling, and it will put pressure on the legislature to make necessary cuts. If Congress does not raise the debt ceiling before the Treasury runs out of borrowing power, it can prioritize which bills to pay. The Treasury may also create a coin worth trillions of dollars to hold in the Federal Reserve, but some doubt the legality and economic common sense of such a plan. Others point to Amendment 14 of the United States Constitution, which includes the validity of the public debt of the United States shall not be questioned. Courts may interpret this to mean that Congress cannot forbid debt payments for obligations authorized in the budget. The legal validity of the argument is debatable at best. Some countries have a debt limit based on the value of their annual productivity, or gross domestic product. Denmark is the only other country with a dollar amount for a debt ceiling, and it is so high they are unlikely to reach it. Is the debt ceiling an unnecessary and dangerous political gimmick, or a critical restriction on the spending of Congress? I'm Frederick Scott Smith. Have a good day. I know I will.